Guys, holiday season is upon us. We've already got through Thanksgiving. We're right here. Christmas is 3 weeks away, 2 weeks away, 4 days, 14, 13, 12 days away. Holiday season is huge in the insurance industry if you're willing to work. Most of the insurance industry is going to take the holiday season off under the false pretenses that people don't buy during the holidays. Well, people don't want to be bothered during the holidays. People have family coming into town during the holidays. Like, people don't buy insurance in the holidays. That is a lame ass excuse for people to take the holidays off and not do anything. And they try and justify it and make themselves feel better by saying, well, nobody else is selling insurance in the holidays because people don't buy during the holidays, or people are spending their money on other things than insurance during the holidays. Let me tell you something. People buy during the holidays. Every single year, agencies will set personal records, company records, and sales during the holiday season, fourth quarter itself, but especially during the holiday season. Records are broken every single year in the insurance industry during the holiday season. Why? Because people buy during the holiday season. There's a plethora of reasons for that. You got people who have family on their minds, people who are thinking, well, this time last year, mom was with us and she's not with us anymore because she passed away from COVID earlier this spring. So this is our first Christmas without mom. Or my brother used to be here with us all the time, and now he's over in Afghanistan fighting for our country. He's overseas. He's not home for Christmas. People have family on their minds. People buy during the holidays because they have their family on their mind. They have the thought process of, I love my family. I care about my family. I want to make sure they're protected and taken care of. And we're dealing with a holiday season now that somebody's not with us anymore, that's been with us all these years, and they've passed away. So people are thinking through the fact that family's on my mind. We're dealing with Christmas season without certain family members who've passed. Mom had to struggle when dad passed. She struggled to keep the home. We all had to pitch in to bury. Like, people have recently experienced death earlier this year, and now they're going through a holiday season where they're missing family members that used to be with them. So family is a big reason why people have insurance on their mind, or not insurance on their mind, but why people are willing to buy during the holidays. You've got people who, because they have family on their mind, they're thinking through, I want to make sure my family's taken care of. They're in the spirit of giving. They're in the spirit of, this is what it looks like with my family, and I love this, I want this, and I want to make sure they're protected. So people buy insurance in the holiday season because they're caring about their family. They want to make sure their family's protected. You've got just the whole attitude of giving, the whole spirit of Christmas, if you will, the whole mindset of there's like, not trying to be dramatic here, but there's a feeling in the air. There's a sense of something special and unique this time of year that kind of gives you the warm fuzzies inside. Selling insurance is an emotional sale. It's a sale that is not tangible. It's not, hey, yeah, come into my house, take a look at my Christmas decorations, take a look at a picture of my kids. Oh, that's my insurance policy on the wall. That's $500,000 right there. Like, that's a piece of, they don't do that. It's not a tangible object. It's an emotional sale. And the holidays bring out an emotional side of us that is a universal thing that happens across the world, where people have that emotion of the holiday season, and they want to act upon that, make sure their family's taken care of. The other big factor into the reason why holidays records insurance sales are set every single year is because the rest of the insurance industry has quit. The rest of the insurance agents out there have fallen trapped to the excuse that people don't buy, so they're not out there working. Well, guess what? That means more business for you. It is an incredibly hot time of the year for people to buy insurance because they care about their family. They're in the spirit of giving. They want to make sure their loved ones are taken care of. They're reminiscing on loved ones that aren't there anymore and how insurance helped their family through that. People buy insurance during the holiday season. Another big reason why people buy is people are home. Agents fall trapped to the excuse that, well, they're so busy doing Christmas stuff with family. Yeah, and they're home. They're not at work. They're not. Sometimes the holidays are the only time that people have a break, a chance to be at home and not be at work like they are during the rest of the 52 months or weeks out of the year. And you've all heard the excuse, I'm busy, I'm working, not right now, like I just got too much going on. Holiday season, people are home. That's a lot of people save up their vacation time, save up their holiday pay, their PTO, and they're off during the holiday season. that's a great time to meet with people and help them protect their loved ones. So do not fall prey to the trap that people don't buy insurance during the holidays. I'll give you a quick example, and this was back 2, 3, 4 years when I was first starting into this, still pretty green, still figuring it out. There was a one particular year where the week between Christmas and New Year's, I didn't have anything going on, didn't have any family stuff going on, and I was just like, I can sit around and just not do anything, or I can go work a couple days a week and make some sales. And that particular year went out and sold, had appointments slam full 2 days that week, just 2 days, and wrote over 14 grand in that 2-day period just between Christmas and New Year's, because people are home and people are buying during the holidays. So, and again, this was back before I, got to where I'm at now. It was still just figuring it out, but understanding that everybody else was taking that time off. All other insurance agents were taking that time off. And now here I had an opportunity to go out and clean house because nobody else was working. Nobody else was doing anything. So I'm just telling you right now, like during the holiday season, the insurance industry is ripe for the picking if you're willing to go out and work for it. So like I said, you have every opportunity here these next 3-4 weeks to be somebody that comes in and just absolutely destroys it during the Christmas, New Year break, because people are home, people care about their families, they've got family on their mind, they're reminiscing about holidays past where family members used to be that aren't with them anymore. And people have experienced death, especially with this, pandemic that we've been in. A lot of people know of somebody that's passed away, and a lot of those people didn't have funds to cover their burial expenses, and their families lost mortgages because they didn't have funds to keep the mortgage payment made and keep the house. So I'm just telling you right now, do not fall prey to the trap that people don't buy insurance during the holiday season. They absolutely do. And it's up to you to decide, am I going to be one of those that goes out and sets records, or am I going to be one of those that struggles financially during the holiday season because I made excuses and believed a lie that wasn't true? So that's my soapbox on that. I'm just telling you right now, people buy insurance during the holiday season. In fact, my wife and I are going to visit her people up in Philadelphia for New Year's. And I've already called a couple clients up in Philly that I sold 4 or 5 years ago when I was dating my wife and would go up and visit her. I'd get leads up there in Philadelphia and run appointments. And I've already called a few clients and told them, hey, by the way, you hadn't seen me in a few years. I'm coming up to Philly, and we need to get together and look at converting some of those term policies that you have. So I'm going to be working while during the holiday season, visiting my wife's people up in Philadelphia. So again, it's there. It's yours if you want to go out and get it. That's all I'm going to say on that. The rest of the 35, 40 minutes or so that we're talking on this, I want to go over what happens when you sit in a home. Let's say you've learned what we've been teaching in the past when it comes to finding policies, finding out what people are paying on. We all know what term life insurance is. We all know what whole life insurance is. And there's that hybrid in-between product, if you will, called universal life. And you need to know what to do when you get into a home and somebody pulls out their policy and you find out that it's a universal life policy. You need to know what to do, how to educate your client on what's happening to that coverage so that they know, hey, I either am good hanging on to this, or I need to sit here and let this agent that's here help me find something better that I can depend on, not an old universal life policy that's going away. So a few of the things that I want to show y'all real quick is, and if you haven't seen it before, you will, and you will sooner than later if you're running enough appointments. What we call universal life on most policies, it is going to say flexible premium adjustable life insurance. Flexible premium adjustable life. That is the key insurance lingo for universal life. Flexible premium adjustable life policy. Why? Because your premium's flexible. You can pay more into it. You can pay less into it. You can skip some payments if you need to. And it's adjustable. You can change the death benefit. You can lower the death benefit if you need to. You can, overfund it in the premiums. Like I said, it gives you way more options with these universal life policies. And the concept of them was introduced here in the US back in the late 70s, 80s. 79, 80, 81 is kind of when universal life products started to hit the insurance industry. And for lack of a better term, it was kind of like a hybrid between term and whole life, without the whole life prices, but still getting decent amount of coverage like what term would offer. So basically, these old universal life policies were designed to be permanent, to be there for the rest of a client's life, but without having to pay the massive whole life rates that whole life products are typically known for and associated for. Now, the advantage to whole life is it's guaranteed. You've got the guarantee that, hey, as long as I make this premium payment, this death benefit is here for the rest of my life, no matter when I die, whether I die tomorrow or whether I die 54 years from now. This death benefit is there for the rest of my life. It's always going to be there come hell or high water, and I'll never pay a dime more than what I'm paying now. That's typically how traditional whole life is known as and represented as, and that's why it's the most expensive. Keyword for whole life is when you die. Whole life W, when W. Whole life, when you die, this death benefit's paying out. Term life, the key word is if you die. If you die during the term period, 10 years, 15 years, 20, 30 years, if you die during the term period, then the death benefit pays out. But if you don't die during the term period, that insurance has lapsed, it's gone, and now you don't have anything. And because it's term life, you're not getting any cash value back out of it. So whole life, when you die. Term life is if you die during that term period. So universal life is designed to be permanent. Here's the problem. When this concept first came back out, interest rates, the market was doing really, really well, especially through the 90s. The stock market was booming. And so what was happening was the cash value in universal life policies was getting insane, crazy interest rates. I'm talking 12, 14, 15% interest growth on the cash value in the policy. And so the way those policies were designed was an insurance agent would do an illustration for a client. Hey, based off the interest rates getting this, if you pay this for the rest of your life and this interest rate stays about the same, then this policy will be here till age 95, 100, 105, whatever they ran the illustration to. Problem is, you had 2001 happen when the towers fell and we went into worldwide, what the heck's going on? And then 08, 09, when the housing market crashed, you've had these massive dips in the stock market that have caused interest rates to come down, and they've never gone back up to what they were back in the 80s and 90s. So when somebody is told, hey, your policy is supposed to get, let's just say 12% interest, and over the last 15, 20 years, it's only been getting 4% interest, simple math tells you that the cash value in that universal life policy has not been growing as much as it was projected. So what happens when that scenario plays out like it is all over America today? And what I've got here that I'm going to show you behind me, and I might turn off this ring light so that you don't see the glare, is a crude illustration of how these universal life products work. I'm not expecting you to be able to read everything. I'm just going to point. Hopefully you can see it enough to, hang on just a second. Hopefully you can see it enough to kind of get an idea. Yay, nay, my screen's all small because I've got everybody's things pulled up. But there's 4 lines that I have drawn on this board here. This top line, this red line, is death benefit, okay? So using our example of universal life, let's just say we've got a $100,000 death benefit, and the death benefit is designed to be there permanently for the rest of somebody's life. So let's just say they got a $100,000 death benefit, okay? They're paying a premium of $50 a month, all right? The plan, like you kind of want for most people want with their insurance, is to know that, hey, whatever premium I'm paying, it's staying the same for whether it's a term period or for the rest of my life. I don't want to take out a policy and then in my later years be told that the premium's skyrocketing on me. I want to know what the premium is so I know how to budget it for the rest of my life, right? So the planned premium, $50 a month, is designed to be there permanently without ever increasing. All right. Hopefully y'all can see those two lines. All right. Every life insurance policy, term, whole life, universal, I don't care what it is. Every life insurance policy has a COI, cost of insurance. That cost of insurance goes up every single year. Why? Because people get older every single year. So a 40-year-old person's cost of insurance is going to be less than a 60-year-old person's cost of insurance. And a 60-year-old person's cost of insurance is going to be cheaper than a 90-year-old person's cost of insurance. All right. So you've got this blue line, this trajectory just going up steadily every single year, representing the cost of insurance. Okay. Your policy premium is designed, whether it's whole life or term life, factors in that cost of insurance, and they take the average, and that's what you're being charged for, is for the insurance. In a permanent policy, universal life and whole life, the cost of insurance is covered in the premium. And then the rest of the premium, outside of policy fees, basic insurance stuff that an insurance company charges that's built into the premium, the rest of the premium is going to build this green line, this cash value. Okay. If you're not tracking with me, go watch the recording again. If I didn't explain it well enough, or you don't understand it, then let's chat later in the week, next couple of weeks, and I'll try and walk you through it on the phone on another Zoom call if need be. But you've got your cash value that is growing in the policy. That is the client's, it's part of their premium that they're paying, is building this cash value. And this cash value, back in the 90s, it was not uncommon to see this cash value growing at 12, 14, 15%. So an insurance agent would sell somebody, let's just say at 40 years old, a policy, and based off the interest rate that the policy was getting at the time, if that interest rate would have maintained, then the cash value would build up enough to cover that cost of insurance in a client's later years so that their premium could stay the same. What's happened is, with these universal life policies, especially ones taken out in the 80s and 90s and early 2000s, what's happened is that interest rate that was building this cash value has dropped from when it was first taken out. And when an interest rate drops, it's not building the cash value as much as it was expected to. Okay. So the way universal life works, when your cost of insurance, so let's just say somebody's paying $50 a month, and when they took out a policy at age 40, maybe the cost of insurance was $13 a month. Well, they're paying 50, right? And the cost of insurance is only 13. Yeah. What's the rest of their premium going to? It's going towards policy fees. It's going towards, well, I'll read some to you. It's going towards administration deductions, face amount deductions, cost of insurance, premium expense charges. There's several things that premium is covering, and some of that premium is building the cash value. Well, as the cost of insurance, like I said, it goes up every single year. What happens is this cost of insurance goes up and the cash value is not getting as much interest as it was expected to. When the cost of insurance exceeds the premium, so now somebody, instead of being 40, they're now 65. Well, now a 65-year-old who's paying for $100,000 of life insurance, maybe the cost of insurance is now $70 a month, but they're only paying 50, right? So it's costing $70 a month for them to keep that 100,000, and they're only paying 50 a month. So they're $20 short each month at age 65, covering the cost of insurance, right? So what happens? That cost of insurance has to be covered. That cost of insurance has to be covered in order for this policy to stay in effect. So what happens is they start pulling the excess from the client's cash value in the policy. Because remember, we want their premium to stay the same. We told them $50 a month. We want them to be able to budget it in their budget for the rest of their life at $50 a month. So when the cost of insurance in their later years, as they get older, exceeds $50 a month, it still has to get paid. Where's it getting paid from? It's getting paid from It's being pulled from the cash value. And remember, the cash value was expected to be this, but because interest rates have not been performing like they were expected to, maybe the cash value is only this. But the cost of insurance, the difference between cost of insurance and premium still has to be covered. So it's going to get pulled from the cash value, regardless of whether the cash value is this big or regardless of whether the cash value is this big. Hope you're tracking with me. So what happens is every single year, as the cost of insurance keeps getting higher and higher and higher, and the premiums staying the same, there's a bigger disparity between what needs to be covered and what the client's paying. And that bigger disparity is being taken from the cash value, and the bigger amount being taken each year from the cash value, the faster that cash value depletes. So when that cash value hits zero, no dollars in their cash value, and their $50 payment does not cover the cost of insurance, one of two things will happen. Either one, they will have to start jacking up their premium payments to cover the cost of insurance every single year, which remember, it's getting higher every single year, or they stop paying on it and the policy lapses. And so what is happening is, as you run these appointments and you sit with people in their 60s and 70s and early 80s, and you find these old universal life policies that were taken out in the 80s and 90s and early 2000s and mid 2000s, what's happening is their cost of insurance is a lot higher than what they're paying in premium right now. And because the difference has to come from the cash value, the amount of cash value in that policy is going to determine how long is that policy going to last based off the premiums that they're paying. Now, you might sit there and say, man, that's a lot of information. Like, I didn't know universal life worked that way. I didn't either when I first started. I didn't sell Forrester's Smart UL universal life product for 2 years when I first got started in the business, because I wasn't super familiar with how universal life policies worked. And I didn't want to mess somebody up or put them in a situation where the policy was going to run out on them a lot sooner than it was expected. So I spent a lot of time on the phone with Forresters. I spent a lot of time talking to other agents in the business that knew how universal life policies worked. And I wanted to get a real good grasp on understanding these products, so I knew how to do right by my clients, not only when it came to selling universal life, but also do right by my clients when it came to educating them on what their universal life policy does. Because I'm going to be honest with you, if you've run any amount of appointments with us, whether you've been doing insurance with us brand new, or whether you've been with another agency or brokerage in years past, if you have run insurance policies with us and you have gotten somebody's policy, got them to go get it and looked at it, and you've come across flexible premium adjustable life insurance, it is a universal life policy. And most of us, if we're brand new and we don't know how these products work, and we don't know just the potential danger that's out there with them, we've seen, oh, they're paying $50 a month and they have $100,000 policy. Well, I just ran a quote at their current age for $100,000 and it was $360 a month. I couldn't beat their price. So we just left it where it is. Okay, you're right. You're not going to beat $50 a month for 100,000. You're not going to beat that as far as price goes. But what you also need to make sure that they understand is at 64, if that's what they're paying, and that's what they've been paying for 20, 30 years, and it's an older universal life policy, that policy will not last much longer. And you need to know that and be aware of that so that you can help them understand what is happening to their policy. And the question is, when I find that, when I come across that in the home, what do I do so that I can understand what's going on and I know how to educate my client with what's going on? And that's the key. That's the key. You've got to know how this works to make sure that you're doing what's right by the client. The good news is the universal life policies today, like for instance, Forrester Smart UL, it's an incredible product. It's designed to last to age 100. There's actually a premium that you can quote them called the Smart Solve, that is essentially overfunding their policy by a few dollars a month to pretty much build that cash value even more to make sure that that policy is going to be there when they need it. So here's what you do when you come across a client that has an old universal life policy. And again, 99% of the time when you look at their policy, it's not going to say universal life. It's going to say flexible premium adjustable life policy. When you see that, and it doesn't say whole life or term life, it just says blah, 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 life policy. That's good indication that you're holding a universal life policy, and you need to understand what's happening to it so you know how to educate your clients. You've always heard me say, hey, call the insurance company if you cannot find the policy. Well, here's the thing about these universal life policies. Every insurance company is required by state law to send their client a current illustration every single year, or a current statement, if you will, every single year on what their policy is doing. Guess what? Whole life doesn't require that, and term life does not require that. Some companies opt to still send something anyway on term and whole life, but the majority of companies don't. So, excuse me, if a client is getting a current statement every single year on the anniversary date of their policy, that is a strong, strong, strong indication that that client is paying on a universal life product. Guess what your client does when they get that illustration? They open it up. Oh, yeah, it's my life insurance. And they throw it in the trash, or they stick it in a drawer, and they don't pay attention to it. They don't know what the heck they're reading. They don't know what they're looking at, and they just file it away. But they can tell you, oh yeah, I get something in the mail every year from my insurance company. Guess what? They're getting their statement, and they don't know what the statement says. They don't care. They just think, oh, it's my life insurance. My life insurance, I'm paying $50 a month, and I have 100,000 till I die. And that is a wrong assumption. It's an erroneous assumption. And that's where you get an opportunity to come be the hero and to help educate them and show them, hey, here's what's happening to this. Here's what you need to be aware of. And when you're able to do that, and you help them see that this is what's going on with this policy, this is what's happening to their coverage, and they had no idea, guess who gets to be the hero now? Guess who gets to be the one to come in and save the day and help prevent them from disaster down the road? You do, because you took time to learn it and understand it and know how these products work. Okay. So whole life, term life, pretty cut and dry. You get their policy, you look and see what they're paying, you look and see what their death benefit is, and you can see based off the schedule of premiums what's going to happen as it goes up. And you can also look at the schedule of premiums and see what's going to happen or where the current cash value is. With whole life, you still do want to find out, hey, have you borrowed any money? Do you have any loans on it? You still want to find that out when it comes to whole life policies, because oftentimes you'll have a client that maybe they borrowed something years ago, forgot about it, never paid the loan back, and it's just been growing and they had no idea. So you want to make sure you know what's going on with the cash value in whole life, but term and whole life is pretty cut and dry. It's pretty simple. With universal life, even if you have the policy in front of you, you still want to call the insurance company, or at the very least, if you have a current statement, a recent illustration from what they got sent to them back on the anniversary date of their policy, if they had that, then that's a great resource to be able to utilize, and you don't necessarily have to call the insurance company. However, most people do not keep those statements. Most people do not know where the most recent statement is. Some people might have a statement from 6 years ago. Okay, well, that's not really going to do you any good, because that was the values from 6 years ago. You need to know what's going on now, or what's going on as of their last insurance policy, or I'm sorry, their last statement on the anniversary date of their policy. You want to know what's going on currently up to that point, so that you know what you can help educate them on what's happening to their policy. So here's what I do. Whenever somebody brings their policy out to me and it says flexible premium adjustable life, and I know we're talking universal life, especially if they've had it, let's just say 5 years or more, especially 5 years or more, you need to take the time to figure out what's going on with that coverage. You need to take the time to call the insurance company and find out what's going on. Or if they have their recent statement, have them get their recent statement. Here's why. Remember, I said interest rates change all the time. So when somebody took a policy out and it was getting 7-8% on the cash value accumulation, now it's only getting the minimum of 2, 3, 4, 3.5%. You need to know that, because that means their cash value is not building as much as it was expected to. And that is going to jeopardize in their later years how long that policy is going to last. So here's questions that I ask the insurance company when we call them. Well, what if they can't find their policy and they don't know what kind of coverage it is? Hear me out. Most people don't know what they have. They don't know what they're paying on. Literally 95+% of people that I sit with that have insurance have no idea what they're paying on. Guess what? I've been doing insurance for going on 11 years now. I've got policies on me, my wife, multiple policies on both of us. I've got policies on my kids. I got policies on my mother-in-law. Like, we pay for a crap ton of insurance. And ever so often, I will pull out my policies to see what exactly all are we paying on? How much coverage do I have? But you're the insurance guy. You sold them to yourself, right? And I still have to check and see what they are. You think a client that bought a policy from Joe Schmo insurance guy 14 years ago knows exactly what they have? No, they don't. And if they do, and they pull it out, and you can verify that it is what they thought it was, kudos to them. They're in the extreme minority. So get people to pull their policies out. And if they can't find their policies, find out who's drafting their account each month and call the customer service of that insurance company so that you know what's going on with that policy. So here's what I asked. Obviously, here's what I'm assuming is that we don't have the policy in front of us. Even if we do have the policy, we don't have a current statement. So this is what you need to find out when you call an insurance company on somebody that has a current universal life policy. You need to obviously find out what the death benefit is. The death benefit will be affected by loans. It can be affected by, I've seen universal life policies where the premium was designed to stay the same, but the death benefit was decreasing the older they got. So their premiums didn't go up, but their death benefit decreased. So what they were paying for 15 years ago for this amount of coverage, now here 15 years later, they only have this, but they're still paying this. Big ripoff. So you want to find out what the current death benefit is. You want to find out what their current premium is. There's a lot of people out there that think they're paying this and they're actually paying this. So you need to know what their current premium is. You need to know what their cash surrender value is. What is their current cash surrender value? Hey, and when you're talking to the insurance rep, the customer service rep, ask them, say, hey, a year ago, not this past statement, but the statement before, what was the cash surrender value? If the cash surrender value a year ago was higher than the current cash surrender value now, what that tells me is they're deducting money from the cash value. Since last year, they've deducted money from the cash value to cover the cost of insurance that's going up every single year. You tracking with me? So if the cash surrender value now is less than what it was a year ago, their cash value is depleting. It's going away. It's going down. It's disappearing because the cost of insurance is higher than their premium. And so they're taking the difference from the cash value. So that's a big red flag if somebody's cash surrender value is dropping from what it was a year, 2 years ago. If it's still growing, then what that means is the policy may be okay for now, but we're not okay with okay for now. We want to be okay with, hey, this is good for the rest of their life. So I need to know what the cash surrender value is now. I need to know what the cash surrender value was on the previous statement, the statement a year before the one that they got last. Are there any loans on the policy? Ask it. The customer service client or the customer service rep will be able to tell you, yes, the client owes $3,220 on this policy. In a lot of cases, the client might have borrowed $1,800 10 years ago, and they never paid the interest on the loan that they borrowed. And so now the insurance company is saying, hey, we gave you $1,800 of your money in your policy that we let you borrow your money, and we've been charging you interest on your money that you haven't paid back, and you haven't paid interest. So now instead of owing us $1,800, you owe us over $3,000. Wait a minute, I only borrowed $1,800. Why do I owe you $3,000? Because your loan that you borrowed from your money, we're charging you interest on it, and you haven't paid the interest. So it's a compounding interest. It's growing every single year. Now it's the loan plus the interest from the year before. Now it's the loan plus the interest from the year before, and it just keeps growing. So you want to find out, does this policy have any loans? If it does, it means that the cash value has been depleted even more from the loan. And now the net death benefit isn't $100,000. It's less now, because the net death benefit is the death benefit minus the loan that was borrowed. And that loan keeps growing, means the death benefit keeps decreasing, means the cash value keeps decreasing, means the policy is going to last even shorter than what it was originally expected to do. So I want to know, are there any loans on the policy? I want to know, hey, based off the current rates, their current premiums and the current interest rate, based off of those two things, current premiums and current interest rate, I'll just say, hey, based off the current values, if the client keeps paying this $50 a month, this planned premium that they've been paying, how long is this policy projected to last till? And if you have a statement from a client, they have their last statement, it'll look something like this. It'll say on here, insured's age at lapse if no further premiums are paid. Well, we're not expecting them to stop paying their premiums, but it'll say insured's age at lapse if planned premiums are paid. So if they keep paying that $50 a month based off of our illustration, if they keep paying that $50 a month, the current assumption is whatever age it says here. Now, this one is a forester's policy from a year ago from a client that I wrote, and he just got his statement a few weeks ago, wanted me to go over it with him. So I did, and I actually have a copy of it. So his policy still projected to last till age 121. Well, he's like 63 years old. If his policy based off his current premiums is still projected to last to age 121, not really concerned about it. Not really worried about it going anywhere. When we took it out a year ago, it was projected to run to 121. It's still currently projected to 121. It's not something to be concerned about. Like I said, the new universal life products are much, much stronger, especially with our carriers. But it will say on that illustration. So if you don't have an illustration in front of you, then that's what you want to ask the customer service rep. Hey, Mary, do you have Frank's current or his most recent illustration there on file? And of course they will. It may take them a second to pull it up, but they'll be able to pull it up. And you say, hey, on that current illustration, it should say somewhere on there that if Frank keeps paying X amount of dollars per month based off the current values, how long is this policy expected to last till? And you want to know what that age is. You want your client to hear their customer service rep from their insurance company tell you and them how long that's projected to last till. And if they say, well, at the current interest rate and the current premium that he's paying, this policy is projected to last till 73. Frank's 67. So the current interest rate is 73. Mary, can you tell us what the guaranteed, based off the guaranteed values, how long this is projected to last till? Yep, just a moment. Yep, based off the guaranteed values, and the premium that he's paying right now, this policy is projected to last till age 70. So now Frank's hearing, hey, my policy's guaranteed for 3 more years, but based off the current rates, the interest rate, the cost of insurance, and what I'm paying right now, this policy is only projected to last till 73. Unless Frank has terminal cancer, Frank's got a big problem, because his policy that he's been paying on for the last 25 years is only projected to last till he's 73 off the current rates, and it's only guaranteed until 70. That's a big problem. But when he took it out 25 years ago and interest rates were a lot higher, he was thinking the policy was going to last till age 100. It was going to be there for the rest of his life, and he wouldn't ever have to worry about paying more than $50 a month. But it's not guaranteed. I'm not going to go down a rabbit hole, but there are, and they're rare, but there are some universal life products out there that have a no lapse guarantee. In other words, you pay this premium, we will guarantee this to X amount of age, 90, 100, whatever. They're few and far between. They're extremely rare. That is a question you can ask when you're talking to the insurance rep or the customer service rep. Hey, Does this policy have a no lapse guarantee based off the premiums that they're paying? And if so, what is that no lapse guarantee? So you can ask that too, but it's not likely that they're going to have that on there. So I want to know what the current rates are and current premium payment is projecting the policy to last till. And then I want to know what the guaranteed rates are going to cause it to last till. These are things you need to find out while you're on the phone with your client. And everything I've just said, as far as these different questions that you can ask your the customer service rep for that carrier, for that insurance company, they can tell you right there on the phone. They can 100% pull up the policy statement, the last statement that was mailed out to that client. They can pull it up and they can tell you all this information that we've just discussed and asked about. When you do that, you will know enough information right then and there as to whether or not, hey, this policy is okay, or we need to fix it now and we don't need to keep paying on this as it's going away, especially if they've got cash value that's depleting. That cash value is going away. It's being eaten up by the growing cost of insurance. So you can really help somebody out by getting that cash value out of there, surrendering the policy, obviously getting them approved first somewhere else, but then helping them surrender that policy and get that cash value out before it continues to be eaten up in their cost of insurance when it's only going to lapse in a few years anyway. And I can tell you right now, State Farm, great company when it comes to property and casualty. Their life insurance sucks. Their life insurance 100% sucks. They're more expensive. They're very picky in their underwriting. And I have yet to see a universal life policy that was actually going to be there when a client needs it. So State Farm life insurance, it sucks. Sorry, Tim. My brother Tim owns a State Farm agency. Their life insurance sucks. Allstate, way worse. Allstate is, I have a client of mine who has her life insurance with me because, and we signed her up in her office, but we had to keep quiet while I was in her office so that her boss, who owned the agency, it was on her lunch break. Don't worry, it wasn't her personal time. It was her personal time. It wasn't boss time. But we had to keep the conversation quiet because she didn't want her boss to know that she was getting life insurance outside of his Allstate agency, because she knew that Allstate life insurance sucks. Their universal life policies are god awful. They suck. And I'm just telling you, especially people that have taken out universal life policies 10 years ago, 20 years ago, 30 years ago, they have no idea what's happening to these coverages until you're the hero that can come along and call their insurance company with them and find out exactly the kind of crap that they're paying on and what's happening to it now, because it wasn't, it hasn't been growing as much as it was expected to because interest rates are at an all-time low. Rachel's a classic example. Just had a client literally this past week, and she sends me screenshots of she did the right thing. She got their statement. Thank God they had their statement. I don't know if the insurance company mailed it to them or emailed it to them, or if they just happened to have a copy of it. The next thing I know, Rachel's texting me pictures of the statement, and she's like, help, I don't know how to read this. I don't know what's going on, but I did what you said and got their information and was able to look at it. And these people were like 59, 60, 61 years old and been paying on these old State Farm universal life policies from several years ago. Not several years ago, like 20 years ago. They took them out when they were in their 30s, early 30s. And here they've been paying on these policies for 20, 30 years. And right there in the freaking illustration, it says, based off the current interest rates and the current values, your planned premium that you've been paying all these years, this policy is going to lapse at age 63. Dude's 61 years old, and he's about to lose this policy at 63 and had no idea. No idea. So guess who got to be the hero and come in and show them, hey, here's what's happening to your policy. I'm sorry, but this is literally, you're at the tail end of it. It's a good thing we're sitting down talking about this right now and looking at this, because what would have happened was in 2 short years, when he's 63, the next letter he would have gotten in the mail from State Farm would have been, hey, based off your current premiums, your policy is lapsing. You need to increase it to this to try and keep this in effect for this year, because the cost of insurance is going to keep going up. And it was just like, oh my gosh, like what in the heck? Like, how do you, well, now you got an opportunity to show them, hey, here's something permanent, something that you don't have to deal with this happening again. This is something that's going to be there for the rest of your life. But it's not 100,000 for $50 a month. Right. And it's not going away in 2 years when your policy that you're paying $50 a month for 100,000 is. So you tell me you're going to die in 2 years? Because if you tell me that, I'm going to tell you this is a great policy. You need to keep it. You need to hang on to it. You don't really say it to them like that. I absolutely do. If they can guarantee to me that they're going to die within the next 2 years, because this policy is only projected to last 2 more years, I will 100% tell them to keep paying on it and that it's the best thing out there for them. But they can't guarantee that. Right. So they need to get something that they can depend on, not something that's about to run out on them in 2 more years. Well, what happens if they just want to keep this until it runs out and then they want me to sign them up? You guarantee their health for 2 more years? You're going to guarantee to me that over the next 2 years, they're not going to have any blood pressure issues, strokes, heart attacks, cancer, hospitalized for blood pressure, any litany of health issues that you could think of that would affect their insurability? Can you guarantee that to them? Yeah, I mean, they look pretty healthy. Okay, cool. Can you guarantee they're going to stay the same age for the next 2 years? Can you guarantee that the insurance company's not going to have a mortality table adjustment and change the, like, no, you can't guarantee any of that. But what can you do? You can get them coverage right now that's going to be there for the rest of their life, so they're not dependent on a policy and at the mercy of a policy that's only going to last for 2 more years. So she picks up the phone, she calls me, says, help. We walk through the illustration, show what's happening to it. She shows them what's happening, tells them what's happening. They're like, no way. And she shows it right there in their statement, what's happening. And it resulted in a sale for over $4,000 in annual premium. Like homegirl just made like $3,500 on that sale. But most insurance agents would look at it and say, oh, they got a policy, they're already paying, and I ran a quote and I couldn't beat their rate. This is why you've got to know what people are paying on. You've got to know what people have. You have to be the one that can help. If they got to know that they can like you and they trust you. And then when they see that you're helping them find out from their insurance company what they have and what's going on with it and what's happening to it, boom, you're the hero for life. And guess what it's going to lead to? It's going to lead to, oh, you should go talk to my sister. She took out a policy the same time I did from this same company, from the same agent. You need to go talk to her. You know, can you look at my mom's coverage? Can you look at, and next thing you know, like they want you to help their family because the time and the effort to sit down and help them and find out what they were paying on, not to make a sale, but to educate and show them, hey, here's what's happening to your policy. And I'll tell you to keep it if you can guarantee you're going to die in the next 2 years or 5 years or 10 years or whatever it's projected to last till. If they know that that you're trustworthy, they know that you care, and then you help them see what's happening to it. And they're like, man, I've been paying on this for 22 years and the agent has never called me and explained this to me or told me this worked like this. I get it. I hear that all the time. That's why I love doing what I do. That's why I love helping people, because you're 71 years old, you're 69 years old, you're my parents' age. And if somebody was sitting with them right now, I'd want them being treated the same way I'm treating you. If somebody was sitting with them right now, I would want somebody to take the time to call their insurance company and find out what's happening to it and show them what's going on with their coverage. Not just somebody that came in, flung an application, and they never heard from again. It's doing right by people. And when you do right by people, it comes back to you. It comes back to you tenfold, 100-fold. But universal life is hard to understand, right? That's why you just took a crash course with me. That's literally like 80% of what you need to know with universal life, sort of. I mean, do a little more homework, but that's the gist of it. And so what's happening is these old policies from the 80s and 90s, when interest rates were gaining crazy money on the cash value, interest rates have tanked. And now they're getting the minimums of 2, 3, 4, 4.5% when they used to be getting 10, 12, 15% or more. And their cash value, instead of being this, what it was supposed to, it's now only this. But that cost of insurance is higher than their premiums now. So the difference has to come from somewhere, and it's coming from the cash value, whether it's this or whether it's this. And when that cash value hits zero and their premium does not cover their massive cost of insurance at their current age, that policy's gone. That policy's gone. No money back, no money back. There ain't no money to give back. Insurance doesn't owe them anything, not a damn thing. Why would people? It's a good concept, but now we have 40-year history of universal life products. And now we know to factor in the fact that the market's going to gain, it's going to lose, it's going to grow, it's going to lose. It doesn't mean their cash value loses if the market tanks. No, it just means that if the interest rate gets dropped from what it was getting, their cash value just isn't growing as much. The Smart UL. When I first started, Forrester's was paying 5.85% on the Smart UL. 5.85%. Guess what? That particular Smart UL for prior to 2020, Smart ULs prior to 2020 are only gaining 4.9 now. It's come down almost a whole percent. You go write a new Smart UL now, it's only getting 4.5%. Guess what? It started at 4.3. Now it's gone up to 4.5. So it's gone up a little bit. Okay, but what happens if it dips below 4.3 or 4.5? Then it just means it's not going to grow as much as the original illustration was expecting it to. And that's where, especially with universal life, you got to be in tune with your clients on what's happening to their policy. The new Forrester's universal life policies, if you sell somebody a universal life policy today, and they're, let's just say 50, 55 and older, it's still guaranteed into their early 90s at the planned premium. That's a solid guarantee. That is a great product. It's a solid guarantee. It's likely going to be there even longer, but it's still guaranteed into their early 90s, 92, 93 years old. If they do the Smart Solve, it's going to overfund it a little bit more, so it's going to last even longer. It's a fantastic product. It's a great product. It's one of my favorite products of all the products that we sell, and I sell the hell out of it. But the old universal life policies from back in the 80s, 90s, early to mid 2000s, those are the ones that are creeping up on people now that they're getting into their late 60s and 70s. And those are the ones that people are getting notices. Hey, your insurance premium needs to skyrocket to keep your death benefit in effect because your cash value is almost depleted and your current premium is not covering your cost of insurance, how much it costs to cover you at your current age for the death benefit that you signed up for 25 years ago. That kind of makes sense. I hope so, because you have an opportunity to be a hero to these people that have no idea what they're paying on. They bought a policy, they stuck it in the drawer, they get a statement in the mail once a year. They just think, oh, that has to do with my policy. Let me stick it in the drawer. Let me throw it in the trash. And they don't pay a lick of attention to it. And you come in and you take the time and you care and you show them what's happening. I'm telling you right now, you will make a huge difference in their life. You're going to make a huge difference in your bank account. And I'm telling you right now that people are going to want you to help protect their families. So don't just look at what they're paying and what amount of coverage they have and think, well, I couldn't beat that price. You have to understand what type of product it is, what's happening to it. You have to be able to know how you can educate them and show them through their company, from their company, what's going on with their policies. And those 5, 6, 7 questions right there, I'm telling you right now, are going to make a huge difference when you make those phone calls to their insurance company and find out exactly what they're paying on. So guys, I hope that helps. I know it was a really, really quick, it's like drinking from a fire hydrant as far as that information. Just remember, I drink bourbon and I know things. So insurance things especially. But I know it was a bit of a crash course on this. Like I said, I'm here to help any way I can. I know we're going to Dallas tomorrow. Hope a lot of y'all are going to be in Dallas. Looking forward to meeting some new people, putting faces with some names as we tour the integrity office and get some crazy good training from a name well known amongst the people on here, Mark Aceta. But hope this was helpful, guys. I just want y'all to understand, when you're sitting in the home, you can't just take a quick look at premium and death benefit and think they're good and you couldn't beat a price. That's not what we do. We're not trying to beat prices. We're trying to help people. We're trying to educate them on what they have. And at the end of the day, if what they have is best for them, we're going to tell them that. But I'm telling you right now, the majority of people you sit with, you're going to be able to improve their situation if you take the time to understand what they're paying on and know how to help them. And we've got the best resources here to do that with our group. We've got more stuff coming out. But this video, this training has been recorded. Yes, it says still recording, so I did hit the right button. But we're going to get this posted. Nick will get this edited and posted up on the legacy page. So anyways, if you're going to be in Dallas, looking forward to seeing you tomorrow. If not, next Monday night, 9 o'clock, as far as I know, we'll be here. So thanks, guys. Take care. Have a good night. Talk to you soon.